As part of her continuing series on the rising risk to real estate, Diana Olick joining us now on set with more. Diana, good to see you.
Good to see you too, Brian. Yeah, from floods to droughts and wildfires, the threat of increasingly extreme weather to homes is clear, but the risk to the mortgage market of a climate foreclosure crisis is just now coming into focus. Hurricane Harvey flooded close to 100,000 Houston area homes, and the vast majority of them had no flood insurance.
Ultimately ended up about 4 feet.
Jennifer and Andy Taylor did have insurance and at the time vowed to rebuild.
The fabric of the community has been amazing.
But as they watched several homes on their street go into foreclosure and the fabric of their community seemed to unravel, the Taylors joined other struggling neighbors and sold to hungry investors who descended on the city.
We have sold.
Houston's strong economy made it a hot housing market before the storm, and investors are still swarming foreclosure auctions like this one now, rekindling images from the foreclosure crisis a decade ago.
I've heard plenty of stories of homeowners who had no choice but to walk away.
In Harvey's federally declared disaster areas, 80% of the homes had no flood insurance because they weren't normally prone to flooding. Serious mortgage delinquencies on damaged homes jumped more than 200%, according to CoreLogic. Houston could have seen a massive foreclosure crisis were it not for that strong investor demand. The next city to get hit by a natural disaster might not be so lucky. In Houston, investor purchases of 10 or more properties jumped nearly 50% in the year following Harvey, according to ATTOM Data Solutions. Some were large buyers like Cerberus Capital and Homevestors. Others were smaller home flippers like J.P. Patel.
As an investor, I mean, it was kind of a perfect opportunity.
Patel and his team have bought more than 80 flooded properties so far.
We literally can avoid the whole problematic nature of the foreclosure process.
And it's not over yet. Even a year after Harvey, neighborhoods like this one are still rebuilding, littered with empty houses and empty lots. Some say all of this should be a wake-up call to the nation's banks and mortgage lenders. We asked Ed Delgado, the CEO of a mortgage industry trade association, if the mortgage market is prepared for increasingly severe weather.
I don't think they are. I think if we look at the basic foundation of what drives the mortgage market is the application of credit risk. What's missing is the understanding of weather risk and where those weather events can take place.
Delgado emphasized that most of the damaged homes in Houston were not in FEMA floodplains.
Well, you have this tremendous urbanization, population growth, roads that are being built in the last 10 years. Where does the water go? And is there an underlying risk for us to examine with respect to our portfolio? And then make decisions. Should we be lending in those markets?
Lenders today and the federal government that backs most loans base their risk on FEMA's flood maps. But even top FEMA officials admit their maps don't account for increasingly extreme weather. David Marstead leads risk management at FEMA.
We can't try to determine what's going to happen in 12 months beyond, because insurance is set up for what your risk is today. And it wouldn't meet actuarial science to charge you for a future potential.
FEMA is required to update its maps every 5 years, and Marstad says it relies heavily on local communities reporting problems. But some don't, because they don't want their insurance premiums to go up.
We know that only 1/3 of the properties in the high-risk area have flood insurance. So we have a lot of work to do.
As does the mortgage industry, which could ultimately see a climate foreclosure crisis.
I think it could come close in terms of exposing lenders to uncontrollable risk. When you have $1 trillion of real estate at risk in coastal markets, it's about time you start paying attention to that.
Most lenders follow underwriting guidelines from Fannie Mae, Freddie Mac, and the FHA, which back the vast majority of mortgages today. So in the end, it may be the taxpayers left holding the bag on climate foreclosures.
Excellent piece, part of your continued series. I got to imagine that FEMA and the mortgage market are going to have much more to say and much more to do on this topic.
Absolutely. I mean, the more storms we get, and I'm not just talking about hurricanes and floods, we tend to show a lot of water in this series, but fire damage also due to droughts. They really have to start focusing on what the risk is, but the problem is right now they're looking at the here and now and not projecting the risk 5 years, 10 years, 15 years out.
It's amazing to me, too, having been in Galveston and Houston during Harvey and seeing the water level, being on some of those boats, that these investors keep buying these homes. Some of them had 4, 5, 6, 8 feet of water.
But they're
For
fixing them up
weeks.
and they're flipping them. The demand in the Houston area, I mean, that was a year later. Hundreds of investors there making money.
All right, Diana, stick around. Okay. Let's turn now to talk more about what is happening in the broader housing market. Joining us is Mark Fleming, Chief Economist at First American. So, Mark, welcome. Thank you. Good to see you. So outside of the Rising Risk series, let's just sort of broaden it out for the regular market here, which is where do you expect mortgage rates to be for the whole of 2019? Because they spiked a lot toward the end of 2018 with the Fed and with the change in the bond market.
Right. I mean, the Fed's been working on trying to normalize rates overall, as well as pushing.
What does that mean, normalize?
Well, 3.5's not normal for a mortgage rate.
No.
So getting rates up into, I think, the 5 to 6% range. That's, you know, we were there briefly at the end. We've had a pullback for reasons outside of the mortgage market in the last couple of months, but I think something in the low to mid 5s is where we should expect to be in 2019.
I've seen a lot of people revising their predictions lower, though, for mortgage rates. It was supposed to be 5, 5.5. In fact, when I did my predictions in December, that's what everyone had, so we did that. And now I'm hearing 4.5 to 5 because of the latest drop.
I mean, there's lots of things that drive the mortgage rate that are really out of control of the mortgage market and the housing market in general, and that's what we're experiencing with a 4.5% rate today. Under more normal circumstances, without recession, all this global uncertainty, I mean, all the things you were mentioning earlier in the show, set those aside, and rates should be
Is there, you know, Diana, okay, so if we go to 5 or 5.5, whatever, we all know, and you've said many times, people don't buy homes on the price. They buy homes on the monthly payment.
Absolutely.
Right? So they do all the math with rates and everything. They say, I can afford $2,000, and this is what it gets me. And they always, by the way, spend pretty much the most that they can. Any sign that the housing market can sort of stand up in the face of higher rates?
Well, you know, we saw in the fall when rates spiked, home sales dropped off really
what about
dramatically.
Prices?
Well, prices started, as I say, the gains started shrinking. They're still gaining compared to a year ago, but the gains in home prices
slowing growth would be a way to define it.
Yes,
okay.
I say gains are shrinking. So anyway, but they're very sensitive right now. I mean, we saw rates drop back in December, and mortgage applications this week, last week, really spiked. I was surprised to see how much on the purchase application side. So there's great demand out there, and as soon as they get, it's not just what can I afford, what can I qualify for.
The most common age in America, the most common 3 years, because I always get it mixed up, so I don't want to say it exactly, is 25, 26, and 27. Those are the 3 most populous age groups in America. There is a huge demographic boom that is coming to this country.
Give us 5 years.
And they're going to start getting married and having kids. And, but then again, you can say, well, they all have so much student loan debt, they can't afford a house. Will that demographic shift benefit real estate long term?
Yes. I mean, we already see it. We're seeing a rise in home ownership, largely driven by millennials, the older millennials already buying homes in their early 30s. And the student loan piece, they gain the benefit of a better income because they're more educated, which is good for being able to buy a house. The data is actually showing that by their mid-30s, there's no difference in the home ownership rate for those who do and don't have student debt.
But you don't believe in this whole millennials don't want to own, they want to rent, they don't want the strings, they want to be urban.
Once you have children and get married, it all changes.
I hear you.
You're so right. I mean, you have that apartment in a city, and then you've got a kid, and all of a sudden that baby crying 4 feet from you, you're like, I need a basement.
Exactly.
I need a man cave to go hide away for that toddler. It's a huge thing. Demographics are going to play a large role in housing going forward.
And I think it's not, everybody talks about the millennials, the baby boomers. I think we should be more focused on them because they're going to be selling, downsizing. A lot of them are buying. A lot of them are in a good, wealthy position now. Following the recession, they were not, so they slowed their downsizing because of the recession. Now they're picking back up again with a better economy.
I'm actually worried about the baby boomers for a slightly different reason, and that is we don't have a lot of supply to give new homes to all the millennials, and that's because more than half of all homes today are owned by either baby boomers or the silent generation, and they're aging in place. And they've got their low rates, and they're locked in, and so they're not going to make that home available, and so all this millennial demand is coming online. Where's the supply?
Yeah, absolutely. A great discussion, a huge demographic shift that's not going anywhere. Mark Fleming, thank you very much.
Thank you.
Appreciate that. First American. Diana, great to see you. We'll see you all day here on CNBC.